The stock market is crashing. Oh no. By now, if you're like me, you're pretty sick of hearing that phrase right now. The stock market dips 2% and every YouTuber and their dog is pulling faces like this. Headlined, the biggest crash ever. This is bad. Sell everything. It's over. You sit back at the chat and you're like, eh? These videos do nothing productive at all, except generate big views for the person talking about it. And they'll leave you thinking, oh no, have I done the right thing? Have I made the wrong decision? Am I about to lose all of my money? If you're thinking like that, then you're in the completely wrong mindset for investing. You need to step outside of that way of thinking and realize what investing is and get back on track. This mindset will literally drain you both mentally and financially. Today, I'm here to ride in like a white knight and tell you why a crash is actually a good thing and why you need it. Stop it, Chris, you can't say that. So if you appreciate the brutal honesty, smash that like button, strap in, and let's go. When I was thinking about how best to illustrate this one thing stuck out in my mind as the simplest way to understand it. So let's say you've bought one share and it's at £1, or even easier, 100p. Now at 5 points you check that share each month and it's moved upwards. 102, 104, 106, 108, and finally 110. Each time you're up 2%, 1.96, 1.92, 1.88, 1.86, or roughly 2% each time. You've made a total of 10% gain. Each time you've logged into your account, you see a nice green number and your face lights up and you feel that sense of accomplishment. I'm on the right track, I'm an investing rock star. Now let's keep that there and compare it to this chart. So this time we start the same, 100, but then it crashes down. We're down to 80, 60, 40, then back up to 70 and eventually up to 110. This time you've gone minus 20%, minus 25, minus 33, time to panic, sell now, just kidding. But then plus 75% and plus 46%. Now this is quite a rudimentary example because realistically this would be over a much longer period of time. Now if I told you your gain was still 10%, which one of these would you prefer to have happen? I know 99% of people would prefer the steady increase, no stress, panic or uncertainty. In fact, if you were a true long-term investor, just set and forget, you wouldn't have even seen any of this harsh crash, or even have thought twice to worry about it or check it, which is the ideal scenario. All that looking will do is literally make you panic and doubt your decisions. This is where we take the alpha mindset to not look and just stick to our game plan. But what if I told you it's actually the second option that we want, the huge swings in price? You'd probably think I was mental.
Sounds like you have mental problems, man.
Yeah, you got mental problems, man.
Yeah, it really does.
To illustrate this, let's forget the investing chart for a moment and pretend we're a shopkeeper. I'm a shopkeeper, the go-to guy where you buy all of your confectionery in my corner shop. And I'm going to sell you a bottle of Coke. Heck, let's make it a bottle of Coke Zero to save you the calories. So let's say in this example, I'm going to sell you the Coke for £1.10 or 110p, just like our share. I'm going to need to consistently buy new stock in my shop, just like you should be regularly buying your shares each month. So using my first example, I bought new stock, and to keep it simple, let's say I just buy from my wholesaler a whopping 1 bottle each month. Yeah, I don't sell much Coke. So bottle 1 I bought for 100, 10p profit, bottle 2, 102, 8p profit, 3, 104, 6p profit, 4, 106, 4p profit, and 5, 108 with 2p profit. In total, I've made a whopping profit of 30p when I sell my 5 bottles of Coke for £1.10. Now that's a pretty damn good return on my investment. Sure, it's not going to pay the bills, but I'm happy with my 30p. So let's do the same with example 2. Bottle 1 starts off the same, 100, 10p profit. Bottle 2, 80p, which I then sell for a 30p profit. Bottle 3 was 60p with a 50p profit. Bottle 4, 40p with 70p profit, and bottle 5 was 70p with a 40p profit. Now in this example, I've made £2 profit. That's 170p more than the first example. That's over 500% more. Now I bet my second example looks a lot more enticing. And this is why dollar cost averaging, or pound cost averaging as it should be called here in the UK, is so damn important when the market looks like it's about to crash. If you lump summed into example 1, you'd have made back your 10% 10% eventually, if you would have waited for what seemed like an eternity. Because remember, in a real world example, it's not just going to be 5 months, it could be 5 years. But averaging in, you'd have made back money even if it didn't get back up to the 110 you were hoping for. This is why I can't stress enough how important consistency is when it comes to your investments. I can hand on heart say, don't check your investments regularly. And that's not really what I should be saying as a YouTuber. I should be telling you Tesla has crashed, Fiverr stock will explode, these 5 stocks will 10x your money by Christmas, but it's just not me. I can't sit here and tell you those things will happen because it's just BS. Invest regularly into a good index fund and that's it. The stress, anxiety and fear is not worth the mental capacity it takes up in your brain. Now I know some people here are going to say,
well, the example you gave was all good and well, but what if it doesn't come back up to 110?
Well, I'm not going to sit here and sugarcoat it. It might not, and that's a serious consideration you have to take into account. Nothing with investing is guaranteed, we're just trying to do our best to get ourselves ahead of where we would be without it. In the 2020 pandemic, the C word, not to be named, the market fell by over 30% in less than a month and took 6 months to recover. In 2008, the housing bubble, it lost nearly half its value and took 2 years to recover. In the 2000 dot-com crash, it plummeted 50% and took a whopping 7 years to recover. And the largest example was 1929, which bottomed out in 1932, and it took over 2 decades to recover. It is worth mentioning here that these examples presume you would have literally put all of your money in at the start of the crash and not invested at all while it was recovering. Just think how much money you would have made jumping in when it was down 50 or 80% and waited for it to recover. People who invested in the FTSE 100 for any 10-year period between 1986 and 2019 have had an 89% chance of making a positive return. This time frame includes Black Monday, the dot-com bubble, and the global financial crisis of 2008. This is why having a clear investing plan is so important. It doesn't even have to be that complicated. I'm going to invest for X years, X per month, and this is what I'm buying. I challenge you, just write that down now on a piece of paper or comment it down below. VWRL, £200 per month, 25 years, easy. Now, of course, it's not so easy if you need the money in the short term, say you're retiring soon or you're retired and you're dependent on that income. If that's the case, then you're trying to guess what the market will do, which is next to impossible. But we know the long-term trajectory in the S&P 500 has been upwards. If you are in that position, then you can hopefully look back and think the position you're in now, be it a pension, you've had really nice growth on the way up, which has got you to the position you're in today. And fingers crossed that that loss isn't into the money you put in, just the profit. That's how I like to look at it anyway. I don't mind losing my gains, but I hate losing the money that I put in. I'm down right now on my pension. I've got less than what I put in terms of cash, but I have had 20% for free, so it's technically still profit anyway. If there's one thing I want you to take from this video, it's not to listen to this doom and gloom. If you see a YouTuber with all this hyped up clickbait, you should take a step back and just think about who you're listening to. I'm by no means a financial guru, heck, I'm not even a financial advisor and I don't want to be, but I'm someone who's made money, I've invested it, and I show you every penny I've got. Just ask yourself if you can say the same for them. And remember, you want to be buying stocks when they are cheap, not when they're high. The lower they go, the better for me, because that's when I'll make those big returns. Right now, you should be looking at increasing your cash positions because those chances will be coming and I want you to be ready for them. And if you don't have the time or money to stockpile a huge pile of cash like you're in the Ozarks,
and if I want to put all $7,945,400 into a hot tub, get buck naked, and play Scrooge McDuck, that is 100% my business. Now, where's my money?
just consistently buy and keep going. I'm going to be making more of an effort to post on my Instagram, so come over and say hi. I think it would be cool to follow some of you guys back and just see what everyone's up to. Do consider joining our investing community over on Discord, and don't forget to grab your free crypto card from CoinJar, link down below, because it's pretty awesome. Thanks for watching, and I will see you guys in the next video.